Good afternoon, everyone. A warm welcome to all of you on behalf of the Colombo Stock Exchange. So as we all obviously know, we as a country is facing an unprecedented period of time. With the level of uncertainty that we are currently facing in, decision making when it comes to managing of financials and investments has been really hard like never before. However, as individuals, it is important that we be vigilant and aware of the market trends, movements in order to make the most and sustain in a volatile market. So today, we, the Columbus Stock Exchange, has joined hands with a panel of experts to discuss and understand the nature of the challenges we are facing in, and more importantly, the actions one must take to face these challenges successfully. So before we move on to the session, a kind reminder to all our participants, y'all can send in your questions by typing them in the chat box. But let's keep the chat box or the comment section only for the relevant questions and help maintain the professionalism of this discussion. So without any further ado, let me cordially invite Ms. Vajirapani Bandaranayake, Assistant Vice President of NDB Capital Holdings, to take control of the proceedings. Over to you, Vajirapani.
Right. Thank you, Dinar. Good afternoon, everyone. Welcome to another Market Insights webinar organized by the Colombo Stock Exchange. Well, we are only still 4 months into the year yet. Still, 2022 is proving to be one of the most uncertain and challenging times for investors, not only locally, but globally as well. If you look at some of the macroeconomic high-frequency numbers, inflation is stubbornly high. Monetary tightening cycles have begun, and the rupee has seen its steepest fall in the history of Sri Lanka. And also, Sri Lanka has announced its first preemptive foreign currency debt default 2 weeks ago. In addition, we are witnessing challenges from both political and social fronts. Also, not to mention about the black swan events like the Ukrainian crisis, which is bringing in another round of shock waves. So as an investor, how should one sustain in a volatile environment like this? Now, this is what we are going to discuss about today. There's a two heads are better than one. So that's why we invited two of the finest brains in the industry to have a deep dive. Today, I will be moderating a roundtable, including Ravi Abesurya, the CEO of Senfin Securities, and Sanjeeva Fernando, the Executive Director Research and the Strategist at CT CLSA Securities. Ravi, Sanjeeva, welcome to today's discussion.
Good afternoon, Vajirapani.
So, ladies and gentlemen, my job here is to keep the questions flowing, but I would like to keep this as interactive as possible. So Ravi, Sanjeeva, if you have anything to add to what each colleague say, please literally just chime in. And I also like to remind the audience, we want to keep this as fluid as possible, so keep your questions coming. And today we have a lot of ground to cover within a limited time frame. So I'm going to start with Sanjeeva. Sanjeeva, I would like to post a high-level question at you as an icebreaker to our discussion. The markets were closed for 2 weeks, and upon opening this week, during the first 2 days, catatonic, market tanked by 15%. But yesterday and today, we have seen a phenomenal V-shaped recovery with the investors bottom picking. And from the earnings front also, now overseas was one of the first companies to release their results to the exchange during this quarter. And they recorded 2.6 billion bottom line for the first quarter, up by 400% year on year and 200% quarter over quarter. And also Expolanca's parent, SG Holdings, released their results today. And as per SG Holdings filings, Expolanca is also looking at a strong quarter in the March quarter, something to the tune of about 30 billion. So my question to you is, amidst all these developments, what is your current assessment about the market? Over to you.
Thank you, Vajrapani. Good afternoon to all of you. So how I would read this scenario is that, yes, we had a massive correction coming into the market with the steep interest rate hikes and negotiated preemptive debt defaults being announced during the past couple of weeks, as you indicated. So now we have a market that has got those corrections in, and now, okay, where are we going to move from this point? I guess earnings, yes, we will have earnings coming in for the March quarter, but most of these policy-related changes happen obviously after that. Now, we are essentially looking at, I guess, the trough of the equity market per se. Why do I say so? You've never, covered equity markets for around close to 15 years now, and have not seen financial institutions being sold at 30% of their book value on forward earnings. So you could say, whatever the expected high NPAs or double-digit NPAs are now factored in, and the anticipated haircuts on certain investments are also factored into these counters. And then again, you have your dollar hedgers. We used to continuously say these were the picks in the market, and then the essential consumer and pharma kind of segments also will be preferred as the country gets aligned to a crisis mode.
Right. Thank you, Sanjeeva. So Ravi, I'm coming to you. Same question with a little bit of twist. As a rational investor, how should an investor view the current market volatilities, and how should one brace himself or herself and structure the portfolio to have a very resilient portfolio?
Excellent question. Actually, if we look at what is going on in the market came down by about 39%. That is basically the SPI. There were a lot of selling pressure emanating from margin providers and broker credit. So the stockbrokers that have given credit, they want to cover their positions. Particularly, they don't want a loss. So they try to force sell. When you force sell, when the market has come down by about 40%, some stocks even 50% or more, particularly the stocks that people have borrowed and invested in large quantities. So that selling pressure comes into the market where, say for example, I'll take one example, export. Everybody is trying to sell export. So that pressure alone makes that particular stock crash. So that came down drastically from about 300 levels to about, I think, 50s or whatever. So it was very unfortunate because this is because of borrowing and investing. Whereas if you have a strategy and if you invest without borrowing, this market would have never crashed. These stocks would have never come down, because when we explain later, Expo, as already Sanjeev mentioned, is that their revenue 90% is in dollars. So in fact, when the rupee has depreciated by about 77%, their revenue has gone up by 77%, which means they would have had a very good year. And their freight rates have increased, and they are not relying on Sri Lanka for their income. It's an international organization which is doing great business. So, why is that kind of stock coming down? It is one reason, that is the false selling. So, people need to understand that and stay put. If you just panic, then you are in trouble. Now, there are two groups of investors. Those who have borrowed, they have no hope, because the lender, to cover their positions and not incur loss, they will force sell. Unless the investor puts in cash or bring in the stocks, somewhere or another, they need to ensure that their portfolios, the margin stays. Because usually the margin providers give about 60%, the stockbrokers mainly give about 50% of your portfolio value. So if you, when the market crashes, there is always that pressure. So number one lesson people need to understand is, if you invest with a strategy, you know why you are investing, you should not panic and sell. If you are borrowed, you need to bring in cash at that point. No harm borrowing and investing when the markets are doing well. But then when the market, for whatever reason, because of volatility comes down, you have to bring in cash and not allow your lender to force sell. If they force sell, you may get zero value for your whole portfolio. So that's the first thing I need to make sure every investor understands what's going on in this market. Now, if you look at the impact from the political, economic, and social aspects to the market, we need to understand there are positive impacts and negative impacts to our stocks. Certain stocks, like banking sector, may have a negative impact, whereas certain stocks which are all revenue is in US dollars or foreign currency will have a very positive impact. In addition to that, certain sectors like renewable energy, consumer staples, healthcare should not have a major impact, because people have to be still, you know, consuming those services or products. So that stocks values will not impact so drastically as the stocks which have a negative impact. So you need to understand in a environment, in this situation, you have to rebalance your portfolio and be in stocks that are going to do extremely well in these circumstances. You know, our dollar crisis is not going to get solved overnight. It will take minimum of 6 months or even more than that, 12 months. So until then, we will be very much focusing on exports to generate whatever dollar income for the country. So exports will be, helping our market as well, because those companies have to do well. They will really focus on that. Same way, other industries, other sectors, as I mentioned, will do well. But banking and NBFIs, we have multi-pronged impacts. The banking, both in the liability and asset side, will have a negative impact, because on the asset side, because of the high interest rates, there will be high level of NPLs. And also, with high interest rates, people may not be able to pay. The moratoriums have come to an end, so they have to start repaying, particularly in the tourism sector and so many sectors that had moratoriums. And on the liability side, there are huge impact because of the likely happen on these international sovereign bonds, ISPs, and also there is mark-to-market losses, because when the interest rates go up, your existing treasury bills and bonds portfolios, you have to realize losses. So you have to mark to market and then realize those losses. It's corrosive. So there are impacts to the banking sector, which is why the banking sector stocks have come down. But that does not mean it is permanent. All the countries in the world have gone through this type of ups and downs, and they will recover. And then you will have fantastic opportunity to gain when you have invested, when the blood is on the streets, in fundamentally strong stocks. But pick and choose long-term stocks which are going to turn around and give you very good returns in the future. I'll stop at that. We'll get into more deeper as we go along.
All right, thank you, Ravi. That very comprehensive overview. Sanjeeva, I'm going to now come to you, especially on the macro side. Now, the government has put a lid on servicing foreign currency debt, and the technical level negotiations with the IMF and the creditors have begun. So as investors, what are we to expect within the next couple of months?
So, yes, Vajrapan. Now, there are a few things that you can expect here from the government side and the central bank side. They will be trying to get external debt restructured. That was the initial indication. And if the proposal that IMF, I mean, if our restructuring proposal like IMF is willing to accept, then we can move ahead with the IMF plan, IMF funding also. So we will, whatever the proposal that we are going to present to the external creditors, they have to agree in principle. I think around 75% of creditors would have to agree on that. So that gives a good signal saying that no domestic debt will be restructured, at least as it stands as of now, which means you won't possibly have a banking crisis kind of thing, because based on IMF data from 1980 to 2020, based on the restructures that they have done, it is evident that wherever there has been some domestic debt restructure, there have been banking crises that have, that were triggered. So fortunate for us, it's not going to be the case. So worst case scenario, it will be economic growth decline or a slight recession, that kind of a thing. So that's what could be expected during next 6 months period, and then obviously a recovery following the agreement on the restructure as well. So that's from the economy side. Your other question was?
So my question was, what can we, as investors, what can we expect in the next few months to come?
Right.
I think you
Yes.
largely answered.
Yeah. So I guess the other aspect will be any impairments as a result of these, any impairments or write-offs from companies or banks or financials point of view that the companies will be taking in going forward. I guess the current valuations kind of reflect the fact that those have been considered and technically the new prices have been discovered. Although kind of we indicated it's a V-shaped recovery, it kind of fell, I think, significantly, and then they recovered around 5 to 6%. So it's good that valuations are at these levels, given that the times are really uncertain, and we are looking at significantly high price pressures from an inflation point of view. Although the reported inflation statistics say around 22% of inflation. We see most of the staples have gone up above 50%, or in the case of energy, it's more than 145%, petrol, diesel, and gas. So on a year-on-year basis. So these will add on to structural inflation plus the pending electricity price increases and VAT adjustments plus income tax hikes also.
Right. Now, Sanjeeva, I'm going to backtrack into your opening remarks. You mentioned that banking sector, the valuations are abysmally low, trading at 30% to the book value. So considering the worst case scenario, let's say like a haircut on foreign currency debt about 50%. Do you think that all these negativities are priced in the prices, and would you recommend the banking sector for the investors right now?
I do not think a 50% haircut is priced in as of now. I believe maybe a max of around a 30% haircut is priced in. Based on the scenarios that were presented, based on the facts, any higher than assumed haircut would probably even have capital calls for certain banks. So I do not think, rather than, we looking this as the investors, I think you have to look it from the investors' point as well. with the 75% of investors will agree on a 50% haircut, because there are other options like some of the strategic investment assets would be long list, or we can do such things without resorting to a 50% per se haircut. So I guess government also must be looking at these options, and it's not just the haircut. Maybe you can kind of resort to some kind of moratoriums and stuff like that. In the case of Uruguay, there were, I think, 4-year moratoriums agreed with regard to creditors. So you essentially may not need significant haircuts if you have those kind of arrangements also in place.
Right. Thank you, Sanjeeva. Ravi, coming back to you. So you explained dollar income stocks perhaps would be one of the best places to be in the current scenario. Now, inflation is stubbornly high. So given a scenario like that, what are your high convictions, the sector themes do you have for an investor to have a defense against inflation?
Yeah, first of all, let's look at what the inflation is. Officially it is claimed to be 20 to 30%. Food inflation is over 30%, and unofficial various market professors and so on said inflation is the highest in the world. It's about 74%. So people feel it, and there's no doubt about surely the inflation. It is coming straight from the money printing that has been going on and the rupee depreciation. So everything has gone up. Fuel prices increase, people increase all the other stuff. So how do we as investors maintain our purchasing power or our wealth? Now, if you are in cash, what 30% inflation means is you are down by 30% by basically end of the year. So what you could buy is much, much less. So you need to maintain that. Keep your purchasing power. That means you have to invest in real assets, which are as much as possible inflation proof. So some of those assets obviously are lands, apartment, things like that, which will keep your purchasing power, because I see daily it's coming, what was 500,000 a purchase, now it's 1 or 2 million. So that kind of increases. We can see apartments also maybe twice price. Some are pricing at dollar monthly installments. So those are moving up. So obviously another real asset is the stock market, because underlying price is a result of companies' performance. So as I said, the companies that are going to get positively impacted will have a tremendous high, which is now proven today. Anyone can take the results of the expo and see how the growth of their income is. So those companies will start performing extremely well. So it is a golden opportunity to get to those really sectors that are going to continue to perform. So my advice is diversification is the key. You don't put all your eggs in one basket, not in the stock market, not in various other instruments. Now today, if you find most people believe in fixed deposits. There are huge risks in that side as well. Hopefully, and that would be not have a local debt restructure. But if so, then there will be negative impacts where there will be haircuts in the local debt, so that all financial institutions will be impacted. So where do you park your money? You have to find some places. So diversifying, so that you don't put all your money in the banks, you don't put all your money in the FIs, or not put all your money in the stock market, or for that matter, real estate. Because when you want to liquidate your real estate, you may not be able to quickly convert it to cash. So there are risks in every type of investment, every asset class. So the best advice I can give you is take a portfolio, is where in your portfolio you are very well diversified into different asset classes. Within the asset class also, you are well diversified. That's the number one rule to follow if you want to have a portfolio which will be as much as possible inflation proof, where you pick and choose depending on the times what are the stocks, what are the investments that will give you enough return to cover your diminishing value of your currency in rupees. In our case, unfortunately, rupee is worth much less as you go to buy anything, you see that. So that's my advice. And the sectors, as I mentioned, again, I would say renewables or the power sector is going to continue to do well because there is a huge demand for power. But I hear that CEP doesn't have the cash to pay those, so they will have to increase the rates. There's no choice. And then CEP will have to repay or not repay, pay the renewable power suppliers that their dues so that they can function and they can pay their debt to the financial institution. So it's a kind of very connected all this. So if CEP doesn't get money or they give it at a loss, it's not going to help. That's one sector. Then, there are other defensive stocks, beta counters, which allows risk management. So that is when the market crashes, those stocks will crash as in the same proportion. Likewise, if the market goes up drastically, those stocks will not go up drastically, but they are much more defensive. So there are stocks like that you can pick and choose based on how the relation between market beta and those stocks beta. So then I mentioned about consumer staples and energy stocks and also healthcare. So if you fall sick, you won't start looking at whether you should go to a private hospital or public hospital. You may have to go to today no medicine in most of state hospitals. So you may have to go to a private hospital where they have the ability to get the medicine and the equipment. So like that, there are sectors that will continue to perform in this kind of climate and also technology companies, which people are now, because of fuel crisis, they are using data, more and more data. So communication companies, they may not have that same impact in their revenue streams, and the cost may not increase in the same proportions. So that's the point I would stress.
Right. Thank you, Ravi. So just to echo on your views also, even farmer distribution sector, I think one of the caveats that were there were the price increases were given belatedly by the NMRA. And I think yesterday the line minister said there will be greater pricing flexibility going forward. So I think that would remove some of the discount that is there in the sector. And in addition to that, I agree with your views on consumer staples because it's a very defensive sector because especially the consumer staples, it's very inelastic demand, so which gives companies higher pricing power. So they have the ability to increase their prices with inflation better than the other industries. And also just to chip in, again, commodities is also a good place to be in when the inflation is running hot, because given that the commodities have a structural linkage to the inputs of inflation. So one can seek to invest in commodities, either directly investing in the commodity itself or a commodity ETF or a future, or those companies that are producing commodities. Now, that's where we are looking at in the SL market, especially the crude palm oil sector. It's a dollar play. And also it's a perfect hedge against the high inflationary environment because of the reasons I mentioned, and also defense against the Ukrainian crisis. A dollar play because the local production is only 10% of the domestic requirement. So therefore, the local prices, they are a function of the landed cost of imports. Also, benefiting from the Ukrainian crisis because the sunflower oil market is affected. So that is driving the demand, prices for crude palm oil. And recent development, the Indonesia has banned palm oil imports. So that's also adding impetus to the sector. But maybe one thing an investor need to keep in mind is commodities. The fortunes of the commodity stocks that are highly dependent on exogenous factors. So you need to have a proper exit strategy because what we see is in the long run, the returns or the valuations of the commodity stocks, they tend to underperform the broad market. So if you are getting into commodities, I mean, this is one of the best times to get into commodity stocks, but you need to have a proper exit strategy because if you miss the top, the markets can be unforgiving. So I was just chipping into what Ravi said. Now, moving to Sanjeeva. Sanjeeva, I would like to get some interest rate outlook from you, now, especially yesterday's bill auction. We saw rates settling below 25% and the auctions got fully subscribed. 87.5 billion was offered, the entirety was taken. Obviously, majority are parked in the short end of the yield curve. So looking at the yesterday's auction and also today's the bond auction, what's your outlook on rates? Do you think the rate cycle has peaked?
Sorry, I think I was muted. Can you hear me, Vajpal?
Yeah.
Yeah.
Loud and clear.
So I guess now the yield curve has inverted. So, I mean, if you look from maybe 1 year back, it was taking a different shape. So yeah, that kind of depicts that in the short to medium term, we will have declining interest rates. So I guess the monetary authority's objective is also, once they get inflation under control, to go for an easing cycle. But we may have to keep in mind that VAT increases and other increases are also pending. So you have to keep an eye on inflation going forward as well, not just the statistic that is published around, because I guess the real inflation is significantly higher than what is reported through statistics based on weights. To answer your question, I think interest rates may have peaked, but can you adopt an easing cycle now? I do not think so, because you have significant price pressures right now. Just to look at yesterday's auction, treasury bill auction, technically most of the bids were accepted with regard to the 3-month tenor, but 6 and 12 not so. So that means technically still there is a mismatch from the investors in this, as opposed to what the regulators expect. So that's probably the mismatch we are talking here. But in the medium term anyway, rates have to come down if we are succeeding through this debt restructure.
Right. So amidst a high rate environment like this, what companies should an investor be positively looking at, and also what companies should they avoid?
Positively, you should look at net cash companies. I mean, just directly looking at this scenario per se, or this aspect per se, you have to look at net cash companies, and you have to avoid high leverage companies with relatively higher floating debt percentages. So yeah, in simple that, and then you will have companies that operate on short-term debt, like property building companies and vehicle importing companies, although those businesses are not allowed to operate in those scales. But so these kind of companies operate with short-term volatile, as in floating debt. So you may have to look at their balance sheets in working with them, investing in those companies as well.
Fair enough. Fair enough. Sanjeev, so you touched on the banking sector. I would like to know your thoughts about the NBFI sector also, now, given that that's one of the sectors that became like a darling of investors last year. Some of the stocks, went this really high valuations, high beta stocks. So in that backdrop, what is your outlook for 2022 for NBFI sector? Should an investor invest or not?
Yes, Vajapan. So, very good question. I guess, given the volatile interest rates, I think an investor should understand how these companies operate, and that essentially means you may have to, formulate your investing strategy based on the dynamics that these companies or the financial institutions have. Now, if you look at a bank, technically, their assets are relatively matched with liabilities, and you're talking technically at least around 40 to 45% of their funding or deposits in current and savings accounts. That's costing less than 4%. And then you have the rest in fixed deposits, and majority is in 1 year fixed deposits. Now maybe you are going towards a longer tenor, but still not significant. But now if you look at a finance company per se, then that was a bank. Finance companies, they operate essentially on the short-term borrowings from the banking system. And then their assets are long fixed, technically with a 5-year duration on average. So that means when interest rates go up, you have your short-term borrowings going up, meaning your cost of funding goes up, but your assets are essentially fixed for an NBFI or a finance company, which means in a rising interest rate scenario like this, their margins get squeezed. But for a bank, it's the other way, because you have kind of 60% of deposits, or maybe even 70% of deposits in fixed term. And that means only, and the remaining funding also is relatively cheap funding. So you won't essentially increase savings rates when interest rates go up, but your loan rates go up. So technically for a bank in a rising interest rate scenario like this, it's positive. Now, the caveat here is obviously interest rates have gone up more than what we've seen in the history of Sri Lanka. So that essentially means, again, you are impacting another segment, that is the debt servicing capacity of the general consumer. When interest rates are going to be this high, we are going to see top private banks having maybe double-digit NPAs even, and then NBFIs could have high-teen NPAs even. So that part's going to shave off whatever the margins that you have. So the current reflection of significantly low book values or price to book values as a result of that.
Right. Thank you, Sanjeev. Ravi, coming back to you, probably this is an unfair question. Currency outlook. Also, an extension to that question would be, now, given that there's a 60-70% rupee depreciation, do you believe the currency risk is largely behind us? Do you expect foreign capital inflows to SL equities?
Very tough question, because we saw the rupee being fixed at 202 for too long, and that created an alternative path for the remittances that were coming to Sri Lanka in the tune of about $7 billion. But that completely vanished, I would say, into that alternative route. And now banks are scrambling, be it state banks, commercial banks, all the banks are having a serious problem because they don't get that remittances that used to come in large quantities without fail every month for the family that is in Sri Lanka. Because these are people who poor, they have to remit money. And that's the main source of income for the industry. So that route has been gone. Then our tourism is seriously affected because of COVID previously, and now with the social unrest and the various country directives that have been issued for tourists in the current Sri Lankan situation. And also the fuel crisis, because of that, the tourist transport is also. So our two key revenue in terms of dollars to the government or importing of our essentials have been lost. But from the positive side, now I see that we don't have to pay our debt. That is the whatever the installment, small loans even that the government of Sri Lanka has got borrowed, that is not repayable. So you may have some money to pay for the essentials, but our reserves position is zero. There is no dollars. So it's like a poor man who lives on a daily wage. If he happens to go out and do some daily work, he gets some money, he will buy some food. So Sri Lanka is in that situation. We don't have any reserves, though you can create a reserve by doing a swap or something like that, but that's not a true reserve. It's not our money, it's borrowed money. So the exchange situation to get corrected, we have to get this bridging finance. That is in the short term. That is from friendly countries like India, China, and even kind of money that is given because we are in such dire straits. Now even World Bank gave $10 million, they're like 100 million, Italy gave 150 million. So like that, just okay, keep this. Basically, those are not even real payable, they are basically grants. Because the country is in such dire straits, we don't have even money to import our medicine. So in that situation, for us to get out from the whole dollar crisis, we have to go for this debt restructuring with the assistance of IMF. Even though maybe the countries who are outside the Paris Club may disagree, still, I think that's our question. We have to pursue an ideal situation, which, as Sanjay said, we will have a situation where we can get time to pay our debt rather than haircut. That will be the best case scenario. Worst case scenario is a haircut, which will have an impact on our banking sector because our banks have also invested in this ISPs or in the sovereign bonds. So yes, the dollar crisis is here to stay for some time until we get maybe, as the finance minister said, about $3 to $4 billion as a bridging finance facility. Then we will have some breathing space. Then hopefully we will get more money to the IMF once we agree to their conditions. And those conditions are going to be very strict. There are a lot of austerities that will happen. There will be no way we will be able to give subsidies. So there will be, of course, social protection for the poorest people and various livelihood maintenance schemes. But dollar crisis will only turn around once we have the fiscal side addressed, the budget deficit. We have get our house in order with financial discipline, so that we will have the ability to generate sufficient revenue for the government and start increasing our exports and remittances, and minimize our exports, our kind of wasteful expenditure on luxuries. I think we may see very soon certain restrictions on open account transactions because people are using these open accounts to bring in all the luxuries at say $440 per rupee, 440 rupees per dollar. And so that open account of transaction. Most likely will go, and then we will have sufficient dollars to buy our essentials, and it will take some time. And I'm 100% sure it will turn up. It has happened in every country that went for restructuring, come out of it. So likewise, the message is it will take time, but we will be, will get out of this situation once we have political, economic, and social stability, and the IMF programs kicked in. That will have a positive impact on the market straight away. So that's why I keep saying to invest long term, make this opportunity to buy selectively fundamentally strong stocks and stay put. Yes, there will be volatility as various news comes to the market. But if you are buying with a strategy, you know what you are doing, you will not go wrong because you are based on analysis which comes from research divisions of broking companies. There are reports published, pick those up, study it, see whether you understand, ask questions, and then pick those fundamentally strong stocks in the sectors we mentioned. And that way, less impact for you on the exchange, right? Because you will get some income coming to weather the increases in what you buy because of the exchange prices.
Right. Thank you. Thank you very much, Ravi, for those comments. I'm going to text you again about investor psychology. How should one manage investor psychology in times like this? I'm asking this because we saw a lot of new investors coming into the market in the December and the January when the tide was high, fear of missing out, FOMO. And then when the tide started receding for various reasons, and then you had like loss aversion mentality. How should an investor train his psychology to face situations like this?
Yeah, this is an area where you can write a thesis about. It's called behavioral finance. It's a whole lot of stuff where people react to various signals in the stock market in a different way. I used to get so many calls. Shall I sell? Shall I sell? People panicking and selling. That's the worst thing you can do during the crisis. And there are unscrupulous people who will even say, yes, they sell to bring that selling pressure into the market. You may be able to buy cheaper later. That's another message I have heard people being told. The market will keep going down for next month. So don't believe in those things, because what matters is whether you have invested the strategy and how you have decided to pick that stock. If your strategy is solid and the indicators are not having a negative impact on those stocks, you cannot be going wrong. It will just pick up in a matter of time. And already yesterday and today you saw it happening. So I didn't tell this, but I said in Friday. We said this on Friday and it happened yesterday and today. So you will have this behavioral kind of psychology where you want to kind of cut your losses and get out. Now that's not the thing you should do, because we all have this fear of making a loss. But what you do is, if you sell, you will have a realized loss. But it's very, very hard to do market time. Now, ideal situation is you should have been able to buy in that 1 or 2 minute market, which was crashing on Monday and Tuesday. But it was just a 90-second market, so you just didn't have time to buy. People were selling, panicking, and selling, but that you can't do. So now market is picking up, and people realize the folly of the selling, or also what really has happened in the market. People have got to know. So it will stabilize to some extent. And when new good news comes, you can make it. So the most important thing in behavioral finance is that you should not be reactive. You should be doing it calculated. You have to be managing the risk based on the strategy you adopted So if you really see there is high risk because of that particular stock is going to get seriously impacted, you should sell. Obviously, as we mentioned, certain stocks will have a negative impact, particularly those who have borrowed a lot of money. As Sanjay said, they are going to get negative impact. But their finance cost is going to go up. Whatever their revenue is, whereas certain other stocks positive. So you may be able to rebalance and survive. So behavioral aspect is not to react when things are going wrong, but calmly assess where you stand, get advice, and rebalance your portfolio, but keep your investments intact. If you have 1 million rupees in stocks, you don't change that 1 million. Get out of stocks. You basically rebalance so that when the market picks up, you are much better off. Certain stocks may not pick up at all. And there are high dividend paying stocks also. So whatever happens in the stock price, you will get a decent dividend. Some stocks were giving about 12% dividend. So, that itself is a really good income, whatever happens. So those stocks will continue to do well if they are not highly geared or borrowed. So I believe behavior aspect is to prevent reacting. There are people very high net worth investors who doesn't look at stocks at all during these times. They just set aside because they are long-term investors. Basically came in like foreign investors. Now you can see another big change happening. Foreign investors are dumping and coming into Sri Lanka. You can see a net foreign inflow, which is unusual. We saw net foreign outflow all this time with the rating downgrade. And now suddenly, last 2 days, yesterday, you see a foreign interest. All of you would have seen Mark Mobius saying Sri Lanka equities and sovereign bonds and sovereign investments is an opportunity. It's now the time to get it, and their smart investors will get it. So, without reacting, please be. You should be able to analyze and ascertain what's driving the stocks, what is exactly the fundamentals of the stock, understand those stocks, drivers, cost drivers, and then make that decision, rebalance your portfolio. That's it.
Right. Thank you so much, Ravi. I think with that, ladies and gentlemen, we are coming to the end of today's session. So to sum up what Ravi and Sanjeev have said, the message is diversify your portfolio and manage investor psychology, and also pick themes that will give you protection in a high inflation and a rupee depreciation environment. So before we wrap up, Sanjeev, Ravi, any final remarks from you?
So I guess, not panicking, especially with the psychological discussion we had. I guess maybe investors could take a leaf out of Mr. Abesuria's book on that, because you will have market crashes. Obviously, we never had a default in Sri Lanka since 1948. So this correction went like that. And now you have some stability at the market, but you have to be careful because you have interest rates, exchange rate, and inflation, everything out of control still. But we have some light at the end of the tunnel with now World Bank, promising to give us some bridging finance, and then other creditors also showing positive signs with regard to that aspect. So it's given that probably we will go ahead with the IMF financing, hopefully by in about 5 to 6 months time, and there onwards. So don't do anything to I mean, don't do anything to make losses right now by panicking and selling, unless you don't see any prospect for that segment at all. So as we indicated in the beginning, maybe dollar hedges, maybe significantly low price to book value financials, especially in the banking sector, not in the finance companies per se. Banking sector will be relatively easy hedges there. And then you will have essential consumer and then pharma still having business volumes despite a crisis. So yeah, focusing on these segments, and then other segments like maybe power and all will probably help you formulate a good portfolio which has a strategic backing to give you better returns in the near term.
Yeah, from my point of view, first, I must remind everybody who invested long time ago in 2000, before 2009, they handsomely benefited as soon as the war ended, and somewhere in June 2009. But then the greediness comes into the picture, and we saw the market going to greater heights. The best performing market in the world kind of. We saw that in Bloomberg in 2010 something. So ultimately the market crashed. So there is this bull markets and bear markets that keeps coming and going. Now again we have is a bear market where the market multiples at about 8 times P. So price earnings is very attractive. Good times comes, and that's where first of all, when bad news hits, we have to be ready, and we have to know that it is not going to last. Bad things will not last. Likewise, good times will not last, like what we saw in January. So we have to be ready for those changes, and I think our market, I would not say I think, I'm positive our market will recover in a matter of, say, as Sanjay said, facilities that comes in 6 to 9 months, it will recover. So, but by the time you react, it may be too late, or the discount, or I would say the supermarket sale will be over, because the smarter guys have got in, and they will be looking to sell when you start thinking about it, because the market has started picking up, and not so intelligent people may start buying it when the market has already gone, because it's still going at a later stage. So then what happens? Then it goes down. Put it this way. You keep buying, but most probably the smart investors are exiting. I think that really we saw that somewhere in January, people started identifying that our market is getting too hot. But some others who thought, oh, it will keep on going. So my advice to you is, these bad times won't last. And this is an opportunity to pick good stocks. So do that cautious, because you will see still bad news sitting. And Sanjay said also, selectively do it because we will see some volatile situations going forward with different news. But there is tremendous opportunity which other investments like fixed income, which may be giving 22% now, most instruments. You may be able to get much higher returns. 22% is after 1 year. The stocks, you may get more in certain stocks, because those have already dropped by 40% or 50%. So they may quickly get back to their prices pretty fast if their earnings are going to go ups and downs in dollar terms. So obviously they may quickly get back to more than the price they were in January. So carefully look at those stocks and pick those stocks. You will not go.
Right. Thank you so much, Ravi, Sanjeeva, for taking time off your busy schedules and joining us today. Ladies and gentlemen, with that, we are coming to the end of today's session. Dinal, over to you.
Well, thank you, Mr. Ravi Surya and Mr. Sanjay Fernando, for sparing your valuable time to share your expertise knowledge with all of us today. And a big thank you to Ms. Vajrapani too for conducting the session and portraying the voice of all the participants to make the session more interactive and informative as well. So for all the participants, I believe the time spent on attending the session itself was an investment for each and every one of you. And I hope this knowledge would come in handy when you have to manage your financials and make investment decisions during this challenging period of time. So don't forget to keep in touch with us as we would bring you up more insightful sessions in the future as well. With that note, thanks again, everyone, for joining in, and have yourself a good evening. Thank you.
Thank you.
Thank you.